Okay, we're recording. This is the Beginner Small Account Trading Group for June 7th, 2018 at Aramir.com. And disclosure is that Capital Discussions and Aramir and me, none of us are securities and investment advisors or broker-dealers, and so we are not making any specific trade recommendations here. Everything you see in here in this session is for educational purposes only. Options involve risk, and you always trade at your own risk, and past performance is not indicative of future results. Okay, and let's see, stop that, get my screen looking right. And I only had I had a note from somebody last week, I think it was, who wanted to look at creating alerts and stop orders in Thinkorswim, which I think would be a great thing to go through today. So we'll do that. And maybe I can talk a little bit about how that would apply to your trades, and talk a little bit about the covered calls. I don't want to spend too much time on those today, but I have a new one. And anything else that comes up, okay? So let's start with the covered call situation. Most of these I haven't checked on in the last week, and unless you want me to, I won't go over every one of them, but I started a new one on Campbell Soup. Oh man, look, I didn't even put it in here yet, so it's not even in this spreadsheet. I need to do that. So let's see here. How am I going to show you? Oh, I think I have a simulated trade for it. Let's look at that. B is Campbell Soup symbol, and there it is. This is a cash secured put. I opened it on, let's see, I have to look that back up here. Let's see. May 31st, okay, when Campbell Soup was at 33.64, and it's now at 33.49, so it really hasn't moved at all in the week and a half or so. I sold two cash secured puts at the 32 strike for 20 July, is that right? And somehow I thought that was June 15th, but probably wasn't. Let's see. Hang on just a minute. I'm going to log in on another screen here to where I can look that up. Because I want to be sure I got this right. Anyway, Campbell Soup has taken a huge decline. If you look at a chart, you can see over the last year, its high was 57.74, and probably earlier than that if you look at a 3-year chart. Let's see what it's done in 3 years. Sorry, this one. Oh, gotta get this right. There we are. 3-year weekly chart. The high is 67 back in 2016, and it's been downhill ever since. And so it's less than half of what it was. Now, I don't know why. I didn't spend too much time trying to figure that out. I did read an article that did some fundamental analysis at seekingalpha.com, and that's a good source of information for these kinds of things. And I felt that it was worth a try here. From a statistical point of view, with a huge drop like that, and with its huge candle right here, which is, remember, this is a week, not a day. Let me go back to the daily chart. 1-year day chart. They had a gap, huge gap down. It looks like it had to do with earnings. So at the same time, this lower Bollinger Band, which you can just barely see, there we go, They've been diverging, and right about here they stopped diverging and both went down, and now the lower one's starting to turn up. So back on the 31st, when I opened this, was this day here. We'd had a down day. The bands were both going down, but at least they weren't diverging, and I thought it would be worth a try. So I picked the 32 strikes, so we'd be out of the money a little bit, and I got a decent premium for it. I got 78 cents. Oh, right, I need to look up the, 1 second, you guys. Oh, it is July. Okay, I did do the July 32 put. So I got 78 cents for it, which I thought was pretty good. And if you think about it, 78 cents divided by $32 is 78 divided by 32 is 2.4% of the strike price that I would get assigned at if I got I had these shares put to me. 2.4% in about a month and a half. Okay. If you try to annualize that, that's about there's about 1.5 month periods in a year. That's 2.4%. Shows that this is a 19 to 20% annualized return trade. Now it's just one trade, and I haven't rolled them and haven't had to do anything yet. But if these expire worthless, then I'll be realizing about 19% per year, even though it's only a month, slightly less than 2 month trade. Graph-wise, we're looking good. I've got all this downside protection. I'm not going to worry about it till we get about down to here somewhere, at which point I'll do some rolling. I'll probably roll them down and out. Possibly increase lot size to 3. If we go up, I won't do anything unless we got clear up into here where the T+0 line has realized a very high percentage of the maximum profit, like 90% or so, 80 to 90%, and then I'll just harvest it and take it off, take my profit and go. So at this point, all we have to do is let this one cook and see what happens. Let's see. I had some questions. Last week's recording not in the library. Well, it was canceled last week. We didn't do one. It was a logistical problem. I was not able to set up a session at Aramir yet because Tom hadn't set up all the permissions, and there was nothing set up at Capital Discussions, and again I couldn't set it up because he's moving everything, so we just didn't do one last week. So you didn't miss one, we just didn't do it. Here did not occur as issue conflict. Yeah, it was permissions. I couldn't get everything working. Okay. Casey, you've sent me a private message. I see that. Let's talk about that after the session or by email or something. Okay. As far as the other calls go, I have re-entered QCOM. I did that also May 30th and 31st. This was a mistake. Originally, not a mistake, but I sold 2 of them. 2 is all I wanted to sell. But I got confused the next day when I was looking at my account, and it looked like I'd only done 1. So I did 1 more, and now I have 3 of them. It's okay. I'll just manage it and see how much we can make off of 3 of them. But I sold the 56 strike June 15th cash secured puts, and I got between 74 cents and 67 cents. If you come look at QCOM now, here it is at 60.54, and I'm down at the 56 strike. So, and it's only got a week to go. If we come look at the quote on those puts right now, 0 by 26 cents. Okay. Which means mark is somewhere around 13 cents. It would be reasonable to just close this out and harvest them now. However, we are 4 points away from the strike price. We have only a week to go. Might as well. This is the wrong simulated trade. Sorry, so you can't look at the graph. Might as well just write it out, and I think that's what the plan will be here. If UCOM gets down to the 56 strike, then I will take the Junes, buy them back for a loss, and sell the Julys. And that, in fact, is why I chose the June strike to start this second round of UCOM with, because I had such a short period of time that if I got into trouble, I could easily roll out to July, and I still wouldn't be too far out in time. So if these expire, I'll have a pretty tidy little profit since I started doing QCOM on April 23rd, and we'll decide if we want to go on with it or not after that. Okay. Dominion, I don't know. I haven't even looked at Dominion. Let's see. They are at 62.39. Strikes are at 67.50. These are covered calls, and so. Oh, those. I'm sorry. These are done. I'm sorry, they're done. Here's my note to myself. Now waiting for X dividend on 5/31, and then I intend to do it again. So that has now happened. I need to come in here and add the dividend into this to track it, and then I can go sell more covered calls. I'll try to take a look at that tomorrow. Altria is at 56.69. I've got two Altria trades. This covered call is now out of the money, but we're just going to let it waste away a bit longer. And then the other one, I have no options right now, but my break-even price is at 62.91 because of where I had to buy them and everything. So at this point, I'm just writing it out. I may sell some more covered calls at the 63 strike if I can get any kind of decent premium for them, but otherwise we might just wait a while on this one. Okay, last one I'll talk about is Duke. They're at 73.48, and Duke, I'm at the 77.50 naked put, so these are still in the money. They're 20 July, so I'm going to let them ride out a little bit longer and waste away a little bit more before I roll them or do something to them. And if I had to take shares on this, that would be okay too. Any questions on the covered calls or the cash secured puts? Now, some of you may be in the covered call service that Tom and Dan have started, and I think they're doing a good job. But they are doing covered calls a bit differently than I'm doing them. Nothing wrong with that. They're doing them more as a pure covered call strategy, and I'm actually trying to get dividends and own shares as part of all this. So one isn't necessarily better than the other. They're just two different ways of doing it. I haven't followed along with any of their trades yet, but I may do that. So, okay, that's about it for the covered calls. Unless I have any questions. Let's see. Nathan says what different. Okay, I'm going to talk about possibly expiring on road trip. Hang on to that, Nathan, for a little bit. Let's talk about alerts for a few minutes, and then I'll come back and maybe look at your question there, okay? So I'm going to close this, and we're in Thinkorswim. I'm going to go to SPX. Okay. Thinkorswim is really powerful about letting you have alerts and contingent orders and managing your trades that way. Some other brokers aren't quite so powerful with that or give you as many options as Thinkorswim does. But it's really nice. And let's let's say you had a trade on and you have added a debit spread as downside protection, okay? So I'll just model the debit spread part of that. If it ever comes up here. There we go. Let's say it was a July trade. I'm just picking something at random to look at here. And let's say you did a debit spread near the money. So that would be, let's say you did 2760 / 2750. You bought a debit spread there. Might look like this. Currently it's at $3 debit. So let's assume that you made this trade as an add-on to hedge to one of your road trips or any other trade that you needed to hedge, and that you paid $3 for it. So I'll lock that. So here's the debit spread by itself, and it looks like a typical debit spread graph. Now you need to manage this both on the downside and the upside. If it moves too far or takes too long, you want to either harvest it or exit it before you lose too much of that $3. So the first thing you can do is you might set up an alert on this. Now if you're, let's talk about the upside. If the market turns around, goes up from here, this debit spread will be losing money because it's a put debit spread. And so it'll be quoting it less, $2.50, $2, $1.50, depending on how far we go and how fast it gets there. And so let's say you've decided that you were going to close this debit spread when it quotes at $1.60. Why did I pick $1.60? That's just about half, just under half of what you paid, which is usually a good target for closing these if they go against you. So the first thing you might want to do is set yourself an alert so that you'll get notified when it quotes at $1.60. Now I have to recall here, let's see, it's been a while since I did it on a debit spread. There is a way to do this. Okay. Copy, delete. Maybe they've changed how you do this. I'm not sure anymore. Alerts are set up from the alert tab under the Market Watch area. Let's see if we can build it. Okay guys, it's changed a little bit, so I'm going to be rediscovering how we do this as we talk. Maybe it'll make it, maybe it won't. Stop that. 70, 2760. Yeah, we go in here, we make it a vertical. The strikes are wrong, so I need to fix those strikes. There we go. We bought the 27, we sold the 2760. There. Okay. So let me start over to show you what I did. I just clicked here in the option chain on the 2770. And then I came up to this box here and I said it's not a single, it's a vertical. And then I had to fix the strikes, and so you click on this down arrow here and you can build your vertical. 2760. And it has chosen calls, so I'm going to change these to puts. Now you see this is modeling the exact trade that we did. We sold the 2760 and we bought the 2770. So now I can create an alert on it. And by the way, this little note column is really nice. You can write a note to yourself that will pop up in your text message and your email that says, what should you do when this alert goes off? I'll just put in some kind of note like that, put debit spread. Okay. Now you come in here, we've modeled the vertical, but what are we doing? We want to know when the mark price is at or below $1.60. That's when we want the alert to go off. Okay, and that should be all we have to do. I don't know why my note didn't stay in there. Maybe it will this time. Okay, and I think that's it. If I hit create, it might be hard to read, but it has created this top line, this alert here. And it's telling you the current quote is 237. Note also that I got the expiration wrong. I meant to have this be July. Let's get this right. We'll go to July. July 20, where'd it go? Whatever. Okay, July 20. Mark at or below $1.60. It's currently saying it's at 340. That's odd, but that's what it's saying. Oh, I picked the weekly. Okay, Thinkorswim's doing its weekly thing again. And now this alert is out here. It's active. You can see right here. And here's my note. Now, depending on how you have configured your setup, that'll determine what happens when this alert goes off. If I go to Setup and Application Settings, and I go to Orders, Notifications, you can select all these different events that you want to get notified about. You can configure what it will do when the alert goes off, and you always have it set to send an email. And over here you can click what columns do you want to see in the alert or the email when you get it, and you can choose different columns. Up here, if you haven't done this, you need to go through this little exercise. You can send up to emails to up to 2 different addresses. But and I can't start from scratch here because I've already done it, but basically what you do is I have one set to my phone number at txt.at.net. That'll be a text message. And I have one set up to my email address, and that'll send me an email. So I'll get both. And this works out well. Okay, so I'm going to cancel out of here because I don't want to change any. Now, once you have set up this alert, you can come into this screen and see every alert that you have. And here's the one that we're looking at. It's still active. Once this gets sent or triggered, that will change to triggered. Okay? And so if you miss the alert, but you happen to look at the screen, you'll still see that it fired off. So that's about it for the alert. Can they be canceled? Yes, you just simply right button and say cancel alert. And it just says canceled here, but I think by tomorrow it will no longer appear in the list. Okay. Okay, Peter, good point. Yeah, I think now that you say that, I think I knew that. If we open market depth and we come down here, here's the vertical. And what do? Do you just right button on it or something? Create alert. Yeah, there you go. Then you get into this same window I had, and it avoids the rebuilding it in here, although you can still update it and change it if you need to in here, but you shouldn't need to if you do all that. That's correct. Thanks for that. Thanks for pointing that out. Okay. Now, there's more you can do. Instead of just having an alert, I would like to have I'd like to have good to cancel contingent orders that will both harvest this when it reaches, let's say, 80% of its maximum profit, and close me out if it loses more than 50% of its value. Okay, Thinkorswim is really good about this. You can set up, you can automate this as well. And what you do is create a couple of orders and have them be one cancels the other. So first of all, to close this out, for profit, I'm going to say analyze opposite trade, and I'm going to create my first order from here, and I'll just say create duplicate order. Now I come in here and I say, well, we're going to sell this thing for $4 credit. Now, if I back up and I come back to this for just a second. If you look at the graph, it has a maximum profit of $700. Well, if it gets to 80% of that, you might want to harvest this and close it out. So 80% of that is 560, maybe, I think. 560, yes. 560 would be right about here on the graph. Now you can put a contingent order in to close this if SPX gets to 2,625. However, the point at which 560 happens will change as time goes by and depending on where the market is. So later it might be down here and you don't want to close it if it's here, you want to close it when it's down here. So if you're trying to get a certain percent of the maximum profit, a better way to do it would be to figure out what price represents that much profit and do it at that price. Well, if you pay $3 for this and you want to realize 560, you need $5.60 profit, or you need to sell it for $8.60. So coming back to our order that we're building, we're going to say if this can be sold for $8.60, then I want this to execute. So that's how you calculate the credit that you want. Be sure you change it to a good to canceled order, and then before you submit this, come to this little box right here, and we're going to say change it to one cancels the other. Okay. Now for that to work, you need to create a second order, and I'll just say create duplicate order. And because I had not submitted the first one, it has now added this order in, and since I said one cancels the other, this is automatically going to be whenever one of these executes, the other one will automatically be canceled by the computer. So what you need to do is set a stop limit, and for this we'll say if it ever quotes at $1.60, and I want to sell this for a limit of $1.55 and make that good till canceled as well. Now I always double check this because I often get these two numbers backwards. So we're going to hit confirm and send, and we're going to look carefully at what they tell us here. Two orders. Sell the vertical for $1.55 stop, limit $1.60. So I got them backwards. Maybe I didn't get them backwards. I always have trouble with this, and I always watch this very carefully. We're going to send this order And now if you look at it in my order list, and I simply say working only, you can see that the close this for profit is working because it's simply a credit, and whoever quotes that, you'll get the credit. The stop limit is sell this vertical at, I think I was reading it backwards, $1.55, limit $1.60. Anyway, you can see that there's this little chain link here. That means these two orders are linked together, and that means that only one, because we made them one cancels the other, only one of these will ever execute. Okay, that's a way that you can automate closing this particular piece of a trade. Now, if you come in here and you decide I want to get out before it's 860, I want to get out at 760, you can right button on that and say cancel replace order and put in your new price, and you can say confirm and send, and it should figure that out and still have a one cancels the other order. See, now we have a order to sell this at 760. It's still chain linked to the stop limit order, and Toss has made sure to get this right so that things will work as the way you want them to. Okay. Let's see here. Okay. Now, let's see. Was there anything else I wanted to say about this? Only that let me cancel these orders. I don't want them to execute in my account. This is live, so I don't want to. I'm going to cancel all of them. Yeah. Now they're all gone. Okay. So one question you might say is, why did I do a stop limit instead of a limit order? Because you can just put or a stop order. Sorry, you can just put a stop order in here and say, if it quotes stop me out at $1.60 or better, you can do this and put this order in. But with options, this doesn't work as well as you wish it did, and as well as it would if this was simply a stock transaction. Number one, options have a bid-ask spread, and it's going to look at the mark and say that's when the stop gets triggered. But if you do it like this, it then becomes a market order. See, it says MKT here, market order, which means it's going to go out to the market and fill it at whatever price it can fill at that time, which probably will be $1.50 or $1.40 credit, which is less than you wanted to get out for, which means you're taking more of a loss than you had wanted to take. The other thing that happens is there'll be a momentary price quote at $1.60, and immediately that turns your order into a market order and it will execute. But if that momentary price quote is even like milliseconds, you won't see it on the chart. You won't see it unless you look at the time and sales data, and even then you might not see it unless you see all time and sales data and not just some of it. And you will wonder what happened because it will appear that it never quoted at $1.60 or below. I've had this happen to me several times. And a couple of the times I called up Thinkorswim and I said, your order messed up, it didn't work. And they go look at detailed time and sales data, which I think is more detailed than I can see. I say, yep, it actually did quote at $1.60, and you had a market order that executed at $1.40, and it was all good. So stop orders turn into market orders when the stop is hit, and you will get out at a much worse price than you expect to. Stop limit orders turn into limit orders when the stop price is hit, but then you have a limit order, say $1.55, it won't take you out at such a worse price because you have a limit. Now, it might not fill right away either, but you'll have a higher chance of getting out at the price you wanted to get out at. That's why, by the way, I chose $1.55 and $1.60. If you have your stop be a little bit higher than the price, you have a really good chance of getting filled when this happens. If you make them the same, you have less chance of getting filled at that time. Okay. Now, let's see. I won't make examples here, but you can even go into Thinkorswim and say, you can have multiple one cancels the other orders, and you can put a stop in at $1.60, and you can put a stop limit, sorry, with $1.55, and you can put one at $1.50 and $1.45. And the reason you might do that is if there's a huge gap down in the market, then you want to be sure that you're out. You don't want to take any more risk of losing any more. By having chained ones at different strikes, and one's a market order and one's a stop limit, one of those will go first and give you a good chance of getting out. It's like the second order at a lower price is the last best hope of getting you out at a decent price. I've done that before. It's a lot of work. Well, it's a bit of work to set it up, and I don't know if it gives you that much benefit, but you can do that if you want to. Okay, so let me delete this. Any questions about alerts or good till cancel orders like that? Okay. Then, Nathan, I see your latest comment. The modeling buying back is sharp, but the price is still above what it would take in commissions to close the trade. So I assume, Nathan, that you're talking about really far out of the money shorts that are like 5 cents or something. That might make sense, what you said there. And what you say is true. The commissions could exceed the dollars that you get for it. But 2 comments on that. Thinkorswim, if you're simply buying back a short put that's out of the money for 5 cents or less, I believe they waive the commission on that, and so there'd be no commission. And you said they're about 45 cents, and so that means I don't understand your question. How would commissions be higher than $45? That part doesn't make sense to me. Eight-lot trade, okay. So if an 8-lot trade is going to cost you more than $45, that means your commission must be outrageous. And you need to get a better commission rate. However, when you're in a situation where it costs more in commissions than it would to sell the puts, then definitely, if it's safe, I'll do the same thing. I won't buy them back. I'll just let them expire. As long as it's safe, as long as they're not causing you risk or anything. Buying back a short. Okay, so you buy back the short for $45. I got it. And if you let them expire, they'll go out at 0, and you won't have any commissions. All that means is it's probably worth staying in the position until they waste away more if they're far out of the money and if it's safe. Okay, I get that now. Thanks. Yeah. So I said a lot of random facts or random things about all this that you can do in Thinkorswim. Now, if you have a butterfly on, you don't want to buy back. Well, you could just buy back the shorts, but now you're kind of making it so that you don't have a butterfly. You have some strange combination of puts. Nothing wrong with that because you'd be net long puts, but then your delta is going to be quite a bit more negative because you're net long puts. And I don't know if you want to carry that much delta or not. So that's something else to look at when you're doing that. You want to be sure that your risk is managed and not outside of limits. For example, go to a butterfly. Let's say let's just pick an out of the money butterfly. Now, we will have bought it at some time in the past. Let's just make it 30 wide. Balanced butterfly, 30 wide. Graph might look like this. So you could come in here and simply buy back some shorts. These are 2740. Let's say we buy back one of those two shorts. Then your graph's going to look something like this. And notice what happened to the delta. It was about 2, and now it's minus 38 just from this one put purchase. Well, maybe on a position of this size, negative 38 delta is way too much negative delta for you, and that would be a reason why you might not want to do this. Depends on what your rules and your strategy are that you're following. And if you did 2 of them, it even looks, it's becoming a directional trade, you know, and your delta is even more negative. Well, if the market turns around and goes up, you're going to get into loss territory right away. So this may not be what you want to do. If you want to do that kind of thing, a better choice might be to buy them back as a debit spread, which simply rolls some of them down. So if I buy the 2740s and sell the 2730s, essentially I'm rolling a put down 10 points. Now you can see it kind of condorizes the graph a little bit, stretches it out the peak. Your delta does not get nearly so negative as it did with a single long put. And maybe that's in line with what you're trying to do. Note that it also becomes looking like a hedge, you know, to the extreme downside. Now you've got something that is profitable all the way down to 0 on the downside. So that's a possible option there, depending on what you're trying to do. Okay. Let me back up here because Nathan, I think I deferred you on a question. Yeah. June 15 road trip with the structure about 150 handles below the market. It's about at max profit. Thinking of just letting it expire rather than pay the commissions to close. What do we think about that? Well, let's model that by saying SPX is at 2770, so let's say 2630 is where your shorts were. Let's say very more than that at 2600. And you had bought this butterfly for something and it was a 2640, let's say 2540 road tip type of trade. And the graph looks something like this. Now, this one is showing basically nothing because we just opened it. Let's say that you only paid 5 cents for this. Now you've got a little bit of profit in this trade. We're way up here. There's all this room to the downside, but should you stay in this trade or should you exit it? Well, if you've got a situation like this where the expiration line is above 0 at a reasonable profit, then anywhere in here, it's going to reach the expiration line by expiration date, and they'll expire, and you'll realize the expiration line profit. That's one consideration. Meanwhile, if the market should really go down, we change this to July 15th because there's only 1 week left. You've got possibility of a higher profit to the downside, even down 150 points from where we are, you'd even make more money because you have negative delta. And so the trade is probably pretty safe. In other words, to the upside, you're going to make the expiration line. To the downside, you could make more. If you don't need the margin for your next trade, this is a reasonable thing to do in this case. However, if you did not have the expiration line above zero, and it was below zero a little bit, like so now I've changed the price so that it's down $20. And day by day, this T plus 0 line is going to go towards the expiration line, meaning down. And at some point it'll go negative, even though you have profit today. Well, the way I watch that is watch your theta day by day, and you can see it's coming down a lot, and by the next day it's probably negative. If and when it goes negative, then I'll be exiting the trade. You're not growing day by day at the current price anymore. True, you do still have this profit potential to the downside, but to the upside or even where you are, it's going to go negative, and you're going to lose all the profit that you had. And I don't want to do that. So I would be exiting in a case like this unless the market started going down and turned into some decent profit. But even in this range, the closer you get to expiration, the more the T plus 0 line will go towards the expiration line, meaning it will go negative even at this price point. So again, we put a price slice here. Right there, it has 28 theta so far on the 9th, but that's going to go negative also at some point, and I wouldn't be staying in there. And that'd be a nice profit on one lot like that. So I'm trying to answer your question. It depends. It's not always just about avoiding commissions. It could be that if it went to the expiration line and it was below zero, you'll lose a lot more than the commissions you'd pay to do this, and you might want it'd be in your best interest to pay the commissions and close the trade. Now, if let's see, if you were in a situation where it wasn't safe to stay in the trade, let me see if I can show you what that might look like. Yeah. Here we are here we are today, and you've got no profit, although at expiration you'll have you'll only be down $20 instead of $30. That's one thing, because it still has positive theta. But in this situation, you do not have any downside protection. This trade is not safe to stay into if there's any market action to speak of. This is the kind of risk that I usually don't take. If I got into this kind of situation, I'm usually going to just exit and take whatever loss I have and move on. To the upside, you know, I guess you could, if the market kept going up and kept going up, you might stay in here because the most you'll lose is $20 by expiration. It's only a week away. Okay, so Nathan, did I kind of answer your question? I hope. Let's see if we have any more questions. Oh, yeah, you have shorts at 25.25. It's even much lower. I'll bet you that this was a trade you opened about a month and a half ago when the market was really low and before it shot up. I had the same thing happen to me. Um, okay, good. That's how I think about that situation. There may be other ways to think about it, but a lot of factors to think about. Now, like today, I had one in a similar situation to that, and I closed them out at a loss because it's time to take that margin to my next trade. And in only another week or week and a half, I think it was 2 weeks, that trade could not have produced any better than it had now. And yet, if the market kept going up, it'd get worse. And so I said, that's it, I'm done. I just took the trade off and move on. And now I don't have to worry about that trade. It's out of the picture. So, okay, there's one more thing I'd like to show you. Let me see if I can do this with one of my trades. Yeah. Let's see. Let's get this thing centered right, and let's get it set right. Okay. Don't read all the trades just yet. This is a live trade. It's a July 20th trade, road trip. But what I did on this trade is I've been buying extra long puts for insurance. And you can see this trade right here, this single, I bought a one lot, July 6th expiration, 2300 put for $3.10 when I opened the trade. Now that's basically black swan protection because it takes a lot of drop before the loss starts to turn around, and even more drop before it gets back above zero. But it gives me a little bit of black swan protection. So that's all well and good, but now we have gone up since I opened that trade. Let's see, I'm gonna look up on my other screen where the market was when I opened that trade, and it was, market was at 27.14 when I opened this trade, right about here. And now we're at 27.70. We've gone up 56 points. And I've done some stuff to it and some adjustments and everything. But here's what I want to show you. Because I've gone up so much, that original put is now even 56 more points out of the money. It's going to be longer before it helps me. And so I decided to roll it up. Number one, selling it. And so I just did this as a debit spread vertical. I bought a 24.25 and I sold a 2300. So I rolled it up 125 points for only 70 cents, $70. Now I have put protection that will kick in faster and sooner. And if we look at, oh, I can't. If we look to the downside now, you can see that this graph starts to curve up a little bit sooner than it did before. If I uncheck this, you can see that it was further on down, like about here somewhere, 23.15. With it, it curves up somewhere around 2400. So I really did roll this up. Because the market has gone up, I was able to do that for pretty cheap. I got 125 points closer to the money, give me more protection for later in the trade, and it only cost me $70. So this was one of my trades today on this, one of my adjustments to this one. Now, I don't know if I should even have long puts right now. That's a matter of philosophy about your trades, but right now I am keeping long puts in my trade as Black Swan Insurance. Okay, so that's what I wanted to show you there. Let's see, do I have questions? Let's see here. Oh, where'd it go? Chat disappeared. Let's see. Oh, there we are. Okay. Sergey, okay. Do you watch your gamma to not exceed a certain amount per lot? If so, what would be recommended maximum? Well, that's a very insightful question. So far in my road trip career, I have not watched gamma very much at all. Typically, if if we're way outside the tent on the upside, then the gamma explosion does not happen late in the trade. I run this thing forward to a week before expiration. I still have only $1.39 gamma. Whereas if the market was here, I have I have 6 times more gamma, and that's what happens when you're near or inside the tent. You're going to have a lot more gamma. Ignore the sign. We're just going to look at the absolute value of gamma. But outside the tent, no. And so all last year and even now, with it outside the tent like this, I don't worry about gamma. If we are near the top of the tent, then I will look at gamma to see if I think it's getting relatively big. Now, I don't know how to define that. This is a 30 lot trade, and that's 10% of the lot size. I don't feel that a 3.8 gamma is too big, but if that was 5 or 6, I do feel that would be too big. So in terms of ratio, you could say if gamma gets to be more than 20% of your lot size, then I'm feeling like it's too big. But no, I don't use gamma as much as I probably should. Now, expiration line is pretty flat, yes. We're way up in here somewhere, and I've got it above 0. See that? It's at $930. So this trade's in pretty good shape right now, and it has a lot of time left to go. And I've got, let's go to today. I've got decent theta. I want more than that, but it'll grow day by day. And my gamma is practically nothing right now. So yeah, this trade's in great shape, and I've been able to do some upside adjustments on it yesterday and today. I'm starting to build that line being above 0, and this trade looks like it's going to be a good trade at this point. So Sergey says, you added overlays and they changed the graph. So what overlays are you talking about? Are you talking about this aspect of Thinkorswim right here? If I change that to gamma, this is what my gamma profile looks like as a function of the price of SPX. Is that what you're talking about? It can be useful to look at it this way. But it's simply the same as clicking a price slice at some particular point and reading your gamma down here. So it's cool to see it in graph form, but you can see the same information on the P&L graph. Oh, I see. Yeah, actually added an iron condor. Okay, because the price ran up so much. Yes, that's right. So you have like a chink down here and maybe a chink down a ways here or something like that on the width of your iron condor. That's a reasonable upside adjustment in a road trip. And so if you got enough credit for it, for the risk that you took, good job. Okay, any more questions? Let's see. One standard deviation, I see. Yeah, that's a pragmatic way to do it. Yep. Okay, with the move to Aramir, Tom gave me a new email address, and it's tim@Aramir. That works. So does this old one, and so does my normal one. You could use any of those if you want to send me a mail. I'd love to get your questions and try to answer them. I don't always answer my emails right away. It might be a day or two before I get back to you, but I try. I'll try to get back as soon as I can. And with that, I guess we'll stop here. Thanks everybody for coming over to Airmere, and it's my understanding that these recordings will no longer be posted in Capital Discussions. You need to go to Airmere for the library. They should show in the library there from now on. And in fact, I don't even think that they'll show in the calendar on Capital Discussions. I think it's all Airmere now. So this is where we want it. This is where we're going to go forward from here. Okay, well, thanks for tuning in today, and have a good trading week, and we'll see you next time. Bye.